This is Barry Zelma speaking for Claim School Incorporated's blog, Zelma on Insurance. Today we're going to talk a little fictionalized real crime story called Liar, Liar, Pants on Fire, where a young man was forced into insurance fraud he thought to survive. The following is a fictionalized true crime story of insurance fraud from an expert who explains why insurance fraud is a heads-I-win, tails-you-lose situation for insurers. If Louie had been born 50 years earlier, he would be called a gigolo. Louie was a classically handsome man. He stood 6'2" tall, combed his black hair straight back in a style that would do a Madison Avenue advertising executive proud. His eyes were an unblinking, watery blue that seemed to caress any woman at whom he looked. He ran 3 miles every morning and maintained a 180-pound lithe physique. Louie had a pleasant personality. Everyone he met liked him. He could drink beer with the boys and sip wine with distinguished and well-bred women. He wore a tuxedo as if Calvin Klein had his body in mind when it was designed. Louie was not smart. Louie graduated from Thomas Jefferson High School in San Jose with a solid D- average. After leaving high school, Louie worked at various menial jobs from janitor to fry cook. He seldom held a job for more than 6 months. Louie loved to dance. On weekends, he would drive up to San Francisco and spend every night dancing in the clubs. It was on one of these dancing adventures in San Francisco that changed Louie's life. Louie met Tony Di Battaglia. They danced every dance until the club closed at 4 a.m. They danced disco, waltzes, and even country and western line dances. Tony told him she worked for the Teamsters Union out of New Jersey and visited San Francisco monthly. When Tony learned that Louie lived in San Jose, she invited him to her hotel and their relationship blossomed. Tony was a wealthy and powerful woman in her own right. She had a husband 20 years her senior who did not understand her. Louie was her release. They were in love. Tony did not love Louie for his intelligence. She did not love Louie for his ability to communicate. Tony loved Louie because he was beautiful, a good dancer, and made her look good wherever and whenever they were out together. She knew he could not afford to live in the manner in which she had grown accustomed. A suite at the Four Seasons Hotel, where she always stayed, cost more than a night than Louie could earn in a month. Only one solution existed. She needed to support him. At first, Louie rebelled. Taking money from a beautiful woman was not proper for a virile, healthy young man. Tony was insistent, and Louie succumbed to her charm. Tony bought Louie a condominium in the Marina District. She helped Louie furnish the condo with antiques to satisfy her taste. She would come to San Francisco for 3 or 4 days every month. Tony gave Louie $5,000 cash each month to cover his expenses while she was gone. Louie could do whatever he wanted except during the 3 days Tony was in town. Louie was a happy man. He lived better than he had in his entire life. He went out dancing every night. All of his clothes were custom tailored. Louie and Tony were a couple, and every time Tony would visit, she would bring a gift for Louie. He did not understand the gifts, but he accepted them with the grace of a well-bred gentleman. The gifts were always personal jewelry or gifts for his condominium. One month she brought a sterling silver tea service that Tony said was a Victorian antique. Next she brought him a sterling silver cigarette case she said the famous Russian jeweler Fabergé made for the Romanov family before the Russian Revolution. She would bring him sculptures, oil paintings, silver candelabra, gold and diamond jewelry on or another bauble that piqued her fancy. To impress Louie, she told him the cost of each bauble. She exaggerated, since he was unsophisticated and money still impressed him. Often she would claim a gift cost her as much as $10,000 more than she actually paid for it. Louie thought he was rich. Louie, adding up what Tony told him she paid for each item, thought the value of his household goods were more than $3 million. Since Tony was away most of each month, Louie became bored. His only passion other than dancing was sports. He had a satellite dish installed on his condominium, and Louie would religiously follow each of the various sports channels. He even watched the Spanish-language sports channel, although he could not understand the commentary. His knowledge of sports was Catholic. He usually knew which team would win and by how much. When he explained his skill to Tony on one of her visits, she introduced him to a bookmaker. Tony suggested that he use his knowledge to make money by betting on sporting events. On her next visit, Louie pleasantly surprised Tony. He made enough betting on sporting events that he refused her cash contribution. She suggested that Louie set up a legitimate business and sell his sporting knowledge to the public. In this way, by just selling his choices, he could avoid any potential problem with the police. Tony had no compunction about violating the law. She just wanted to keep Louie safe for her pleasure. Running the business kept Louie busy and made him more lovable to Tony. Their relationship continued for 10 happy years. On a faithful November Sunday, while watching a San Francisco 49ers football game, a news flash interrupted the game to announce a mafia massacre in New Jersey. 4 Teamsters Union officials, allegedly members of the Tortellini crime family, had been found dead in a parked Lincoln Town car under an overpass of the Jersey Turnpike. All had been shot 3 times in the head with large caliber weapons. One of the dead was Tony Di Battaglia. Louie mourned. He no longer had a source of income and gifts. His sports business was failing. The partner he chose had taken all of the company assets and gone to Aruba. He was broke. The love of his life, who supported him for many years, was dead. He had no skills, no profession. Louie owned his condo and could mortgage it, but the proceeds would keep him only for a short time. Louie needed a plan to make a large amount of money. He wanted to live and continue to live comfortably until he could meet someone else like Tony who would support him in the manner he had grown accustomed to living. The solution was his condo's owner's insurance policy. Tony had insisted that he always keep a condo owner's policy on his condominium. His condo owner's policy had a $400,000 limit, although Tony had led him to believe that the antiques she had given him were worth more than a few $1,000,000. He would just make a list describing the various items in the condominium and place beside each description the amounts Tony told him she had paid. He would then report to the police and his insurance company that he had been robbed of items very much like the items in the house. Neither the police nor the insurance company could prove, since Tony was dead, that he was lying. The amount claimed would be more than the policy limit. Louie was sure the insurance company would pay the $400,000. Just before Christmas, Louie called the police to report that 2 armed robbers had come to his door and, pretending to be UPS delivery men, gained entrance. Holding him captive with pistols, he would say they removed from his condo more than $1 million in silver, fine arts, and jewelry. Included on his list were 25 bronze statues by Ertea, George, and Silver Epern, 3 Fabergé silver and gold cigarette cases, 2 Fabergé picture frames made of semi-precious stones, gold and silver, a Victorian silver tea set, 2 Georgian sterling silver tea sets, a Victorian sterling flatware service for 12, 2 diamond rings, and a solid gold and diamond Rolex watch. The total value of the items Louie claimed stolen equaled $1,300,000. The insurance company assigned a staff adjuster to investigate the loss. The adjuster was a 25-year-old young woman who had started the profession 2 years before the day Louie reported the robbery. The opulence of Louie's condominium and his good looks blinded her. It was clear to her inexperienced eye that the house was full of lovely antiques. She had no reason to disbelieve Louie when he told her that what was still in the house was worth more than $2 million. She presented the claim to her home office and recommended, since the loss exceeded the policy limit by a factor of 3, that they pay the full policy limit. Older and wiser people resided at the insurance company home office. Before they would authorize payment of $400,000 on a claim, they wanted evidence that the values Louie asked them to pay was reasonable and substantiated. They accepted the adjuster's report as fact that Louie got all of the items as a gift. The insurance company accepted that he could not therefore prove ownership or value. They expected, however, that he could, by comparison to the items still present, provide enough description to allow them to establish the true value of the items stolen. The insurance company hired a fine arts appraiser who visited with Louie. The appraiser, looking at the initial written list, knew that Louie was unsophisticated about antiques and items of art. He could not spell Fabergé or Byrne, and seemed to have difficulty with describing his items of silver. He would describe, for instance, silver as Victorian, and yet insist it was manufactured before Victoria took the throne. Louie claimed Sheffield silver as sterling, not knowing that Sheffield was famous as a center for a specific type of silver plate. The appraiser studied the silver and other items of art Louie still had in his house and was convinced that his claim of values was fraudulent, or at least very highly inflated. The values stated on Louie's claim did not agree with any reasonable market. The items he claimed to be Fabergé were undervalued by thousands of dollars. Silver items claimed to be Georgian and Victorian were overvalued by a factor of 3 or more in the opinion of the appraiser. The appraiser reported his conclusions to the insurer, and the insurance company's home office personnel, to aid Louie in describing his property, hired an attorney experienced in fine arts. The lawyer was instructed to examine Louie under oath and hoped that the lawyer would gain more detailed descriptions of the items stolen. They expected with professional questioning Louie would establish the true amount of his loss. They could not pay because their appraiser told them the loss could be in a range from $40,000 to $1 million. Louie testified for 2 days. He was frightened. The lawyer, although always friendly, caused Louie to break out in cold sweats he hoped was not visible. He did not tell the truth about anything to the lawyer. Louie limited his descriptions of the property stolen to the list he had written before he called the insurance company. Despite how detailed the lawyer's probing, Louie stuck to the description he had written. When the lawyer questioned Louie's ability to earn money to keep up the condo, he created a story to show how he had a source of income. Louie told the lawyer that Tony's family sent him, after her death, an annuity of $10,000 cash each month that came in plain brown baggage via UPS. When the examinations under oath were finished, the insurance company and its lawyer were convinced Louie was attempting to defraud the insurer. The lawyer, with the approval of the insurance company, advised Louie his insurance claim was denied. Louie sued. 5 years later, a Superior Court jury, after hearing all of the evidence, sent him away with nothing, although Louie was a convincing actor. The jury concluded only that Louie had been robbed. The jury concluded also that he had lied to the insurance company about the existence and value of the property. They gave judgment for the insurance company, and it didn't have to pay $400,000 to Louie. Of course, it did find itself paying more than $700,000 to its lawyers and experts who made it possible for them to win the lawsuit. Insurance fraud did not pay for Louie. Fighting fraud, however, on the surface saved his insurance company nothing. In fact, to defeat the fraud, the insurance company spent more than it would have cost if it had paid his claim in full. However, Louie's insurance company gained the reputation of being a fighter and found very few attempts at fraud in the next few years, which saved it 10 times what it cost to defeat Louie's claim. Justice was done, and Louie lived happily ever after. During the trial, he met Carla, a CPA, with offices on the 23rd floor of a building on California Street that his attorneys hired to prosecute his claim. Carla took Tony's place. Louie still lives in his condo surrounded by antiques, and whenever Carla visits, Louie receives a new bauble. Carla pays his expenses. Louie will never again try insurance fraud. This video was adapted from my blog, Zelma on Insurance, and my book on insurance fraud costs everyone. It's available at Amazon.com for a very small fee, and you can subscribe to the blog if you click on the URL zalma.com/blog. If you do, you'll be advised of all blog postings, usually 5 or 6 a week. If you're interested in insurance claims, and insurance fraud, you might consider subscribing for a very small fee to my Substack publications. And I'd appreciate it if you tell your friends and colleagues about this blog and the videos and let them subscribe as well. Thank you for your attention.